horizon, can gold sustain its rally until 2035? Introduction. The allure of the eternal metal. For millennia, gold has captivated humanity, serving as currency, a store of value, and a safe haven in turbulent times. As of late 2024, gold trades near historic highs, fueled by geopolitical strife, inflation concerns, and shifting central bank policies. But can this ancient asset maintain its high momentum trajectory for over a decade, through to 2035? The answer is not a simple yes or no, but a nuanced analysis of powerful tailwinds against formidable headwinds. The bullish case: fuel for a sustained rally. Several structural factors suggest gold's momentum could have staying power. 1. Geopolitical fragmentation and de-dollarization. The post-Cold War unipolar moment is over. Rising tensions between major powers, regional conflicts, and economic sanctions are pushing nations toward strategic autonomy. A key manifestation is de-dollarization. Central banks, particularly in China, India, Turkey, and emerging markets, are aggressively accumulating gold to diversify away from U.S. treasuries. This isn't a fleeting trend but a long-term strategic shift likely to persist through 2035, creating a consistent, institutional bid for gold. 2. The debt super cycle and fiscal dominance. Global sovereign debt is at record highs. With the U.S. national debt exceeding $34 trillion and major economies struggling with deficits, the era of fiscal dominance is here. Central banks may be forced to keep interest rates lower than inflation warrants to manage debt servicing costs. This environment of financial repression, where real returns on bonds are negative, is historically fertile ground for gold, which pays no yield but preserves purchasing power. 3. Monetary policy and loss of faith in fiat. The 2020s have eroded the trust pillar of fiat currencies. While central banks aim for 2% inflation, the memory of recent surges and the sheer expansion of money supplies linger. Gold is increasingly viewed as a monetary insurance policy. Even if inflation moderates, the precedent has been set, and trust is hard to fully restore. Any future crisis that prompts extreme monetary easing will rocket gold prices. 4. Physical scarcity and production challenges. Gold mining is capital-intensive, environmentally scrutinized, and geopolitically constrained. Major new discoveries are rare, and ore grades are declining. It takes 5 to 10 years to bring a new major mine online. Supply is likely to remain inelastic, meaning a surge in demand like from central banks cannot be quickly met, amplifying price upward moves. The bearish headwinds. What could derail the rally? However, a straight line upward to 2035 is improbable. Significant challenges loom. 1. The interest rate dilemma. Gold famously struggles in a high real interest rate environment, nominal rates minus inflation. If central banks succeed in taming inflation while maintaining elevated policy rates, the opportunity cost of holding non-yielding gold rises. The momentum could stall or reverse during prolonged periods of restrictive monetary policy, as seen in the 1980s and 1990s. 2. A resurgent U.S. dollar and economy. The U.S. dollar remains the world's premier reserve currency. A scenario of sustained U.S. economic outperformance, technological leadership e.g., in AI, and energy independence could bolster the dollar, making gold more expensive for foreign buyers and damping its appeal. A strong dollar regime is a classic gold headwind. 3. Technological disruption and alternative assets. Digital assets, tokenized commodities, and new financial instruments compete for the alternative asset portfolio allocation. While gold's 5,000-year track record is unmatched, a younger generation of investors may favor digital stores of value or yield-generating assets. Furthermore, breakthroughs in asteroid mining, a very long shot by 2035, or efficient extraction from seawater could theoretically alter the scarcity narrative. 4. Market psychology and overvaluation. All bull markets experience corrections. Gold is prone to sharp pullbacks after rapid ascents. A deep global recession causing deflationary shocks and liquidity crunches, where even gold is sold to cover losses elsewhere, could cause significant interim volatility, testing the conviction of momentum investors. The path to 2035. Probable scenarios. Rather than a continuous upward slope, the path to 2035 will likely be a volatile staircase with a rising trend. The bull scenario: high momentum maintained. This requires a perfect storm of persistent inflation above 3%, escalating geopolitical tensions fragmenting trade, continuous central bank buying, and a loss of confidence in traditional bond markets. In this world, gold could transition from a portfolio diversifier to a core monetary asset, potentially reaching inflation-adjusted new highs. The baseline scenario, strong volatile trend, this is the most probable path. Gold experiences significant pullbacks 15 to 25% during periods of economic calm and high real rates but finds solid institutional buying at lower levels. The long-term drivers debt, de-dollarization, scarcity push the nominal price higher over time, but the journey is marked by significant volatility. Think of an upward trending channel with large swings, not a parabolic curve. The bear scenario, momentum fades. This involves a return to the pre-2008 inches great moderation, global peace dividends, coordinated fiscal discipline, technological deflation, and a renewed faith in central bank stewardship of fiat currencies. In this unlikely but possible world, gold's rally stalls, and it trades range-bound, losing its momentum allure. Conclusion: an anchor, not a rocket. Gold is unlikely to provide the continuous, smooth momentum of a high-growth tech stock. Its role is fundamentally different. By 2035, gold is poised to be more relevant, not less. Its momentum will be driven by macro shifts, not quarterly earnings. For investors, the key is to view gold not as a speculative momentum play but as a strategic hedge, a form of financial insurance within a diversified portfolio. Allocations of 5 to 10% can mitigate systemic risks that are growing, not shrinking. The period to 2035 will be defined by transitions in the global monetary order, climate change impacts, and demographic shifts. In this uncertain landscape, gold's ancient luster is finding a very modern purpose. The momentum may be intermittent, but the trajectory, supported by deep structural forces, points toward a higher nominal plateau by the dawn of 2035. The eternal metal is preparing for another epoch-defining chapter.
Please subscribe for more useful information.